Hello learners, welcome to Drishti CUET undergraduate program and I am your mentor Shashank welcoming you all in today's session. Learners, today I will be discussing with you the topic of national income and this is one of the most important topics from the economics section because last year as well the question came from this particular topic in CUET general aptitude test. At that point of time it was known as general test. So there was two questions from national income segment in CUET UG examination. So it is one of the important segments that is for the CUET. So let's start the session for today. So let's begin the session for today guys, and today I will be discussing with you the section of national income. So first of all, let's discuss about the introduction of the national income, ki what exactly it is. So my dear learners, what is national income? So we will go by the basics so that if you have not read economics as well, so then still you will be able to understand the whole scenario. Now guys, first of all, what exactly is the national income? So let's discuss the definition. So definition of national income is, in national income it is a monetary value of all the final goods and services produced by the citizens of the country in a financial year. So it is the monetary value of all the final goods and services produced by the citizens of the country in a financial year. So first of all, there are some keywords in this definition. So first keyword is monetary value. So what is monetary value? So value in terms of money. So value in terms of money, my dear learners. So value in terms of money is called monetary value of all the final goods and services. Now what is final goods? Final goods and services. So first of all guys, let's discuss what exactly is the service. Service, they are intangible goods. So services, they are intangible. Intangible goods, they are called services. So intangible means that cannot be touched physically. So that cannot be touched physically. So just you can feel the things that you cannot touch. For example, teaching, it is a service. Then banking, insurance, telecom, and internet. So they are the service that you cannot touch physically. So first of all guys, services, I hope everyone understood what exactly is the service. So service, they are guys intangible goods, that is called services. So services are like intangible goods that cannot be touched physically. Now what is final goods and services? Final goods are those goods which cannot be which cannot be further value added. So the final goods, now guys, final goods are those goods which can't be further value added. So those goods which cannot be further value added, that is called final goods. For example, my dear learners, if you purchase rice, if you purchase raw rice and then you make a dish out of that rice, for example, if you make biryani, so can you make some any other product from biryani, from converting the rice into biryani? So can you value add the biryani? I am not talking about garnishing the things and giving some extra. So what I wish to say, ki if you want to value add in biryani, can you do? But you can value add in the rice. So my dear learners, final goods are those goods which cannot be further value added. That means you cannot make something another out of that thing. So generally guys, what we have been taught in school, ki what are final goods? Those goods which are ready to be sold in market. This is a very popular definition. This is popular among the school students. Okay, what is the final goods? So final goods are those goods which is ready to be sold in market. Now, first of all guys, the rice can be sold in market, raw rice like you purchase in grocery, and biryani is also sold in the market. But if you purchase that raw rice and make biryani, so first of all what you do, so this rice will be double sold, so that will be double counting. Therefore my dear learners, in avoid to avoid the double counting, what exactly is the definition? The definition is that the goods which cannot be further value added, they are called final goods and services. Now you cannot modify the things. Similar example, cloth. Suit length, for example, you purchase a suit length to stitch suit. Now the suit length is also sold, and you made suit from that suit length which is also being sold. So once you will find that that suit length is also sold, and from that same suit length you made suit, that is also sold. So what it will find? It will find double counting. If you will go by old definition, the goods which is ready to be sold in market is called final goods. So that is not the correct definition, because that will invite double counting of the things. So what exactly is the definition? The goods which are cannot be further value added, they are called final goods. Produced by the citizens. Citizens means citizens who are living in India. So who are living in India plus citizens living abroad. Abroad of the country in a financial year. So for India guys, if I talk about India, this is from 1st April to 31st March. So this is the financial year for India. So guys, generally this is the definition of this national income. It is the monetary value of all the goods and services, which is all the final goods and services which is produced by the citizens of the country in a financial year. So in national income, only the monetary value after selling the final goods and services of the citizens, they are being added. I hope it is clear to all of you. Now next is the calculation of national income. So in India, national income is calculated from 1st April till 31st of the March. So it is the financial year in which it is being calculated. Now, which authority calculates the national income? So, national income is calculated by Central Statistical Office, that is called CSO, Central Statistical Office, and that works under Ministry of Statistics and Program Implementation. This is called MOSPI. So, Ministry of Statistics and Program Implementation, the it is the ministry that calculates the national income, and under Ministry of Statistics and Program Implementation, it is did by Central Statistical Office. Now, what is the base year of calculation of national income? Earlier it was 2011-12. Now it is being changed to 2022-23 on recommendation of Vishwanath Goldar Committee. So on recommendation, so earlier it was 2011-12. Now on recommendation of Vishwanath Goldar Committee, on recommendation of Vishwanath Goldar Committee, it was a 26-member committee. The base year is changed, and now the base year is 2022-23. Is that clear to all of you? Is that clear to all of you guys? Then do let me know. So I hope guys, is that clear to all of you? Okay, what was the base year? So earlier it was 2011-12. Now it is changed to 2022-23. And Vishwanath Goldar Committee that recommended the change in the base year, and it was a 26-member advisory committee. So it was a 26-member advisory committee. 26-member advisory committee that was being head by Bishwanath Goldar, and that recommended to change the base year. Now guys, what is base year? Base year guys, it is a reference year for calculation. So base year exactly, it is a reference year. Base year is a reference year for calculation. And the year that shows least fluctuation in market, that is considered as base year. So the year that shows least fluctuation in market, the year that shows less fluctuation in market, that is taken as B. This is taken as, so the year that shows less fluctuation in market, that is taken as base year. Why it is taken as base year? To make the calculation simpler. So earlier guys, it was 2011-12, so it was a bit outdated. So finally what was decided ki now let's change the base year for calculation. So earlier which was 11-12, now it was changed to 2022-23. So 2022-23, this is the new base year, and it was recommended by 26-member advisory committee that was headed by Bishwanath Goldar. So this is also known as Bishwanath Goldar committee, and base year is that year that shows least fluctuation or the less fluctuation in market, and to make the calculation simpler, this is taken as base year. Is that clear to all of you? Okay. Now guys, let's come to the next thing, that is the history of national income. So now guys, we are going to discuss the history of national income. So history of national income, that is divided into two parts, that is pre-independence, that means before independence, and post-independence means after independence. So pre-independence and post-independence, we have divided the discussion on the national income, that is before independence and after independence. We are going to discuss about the national income. Now guys, first of all, let's discuss about the pre-independence. So before independence guys, there was attempt to calculate the national income. So in 1867-68, Dada Bhai Nehruji. So Dada Bhai Nehruji, and Dada Bhai Nehruji guys, he is also known as Grand Old Man of India. And he, for the 3 times he became the president of Indian National Congress, Dada Bhai Nehruji tried to calculate the national income of India, and that he calculated, that he attempted to calculate national income in his book. National income in his book. And actually guys, the name of the book was Poverty and Un-British Rule in India. And this Poverty and Un-British Rule in India contains the theory, of drain of wealth. This contains the theory of drain of wealth, and actually Dada Bhai Nehruji, he tried to estimate the national income, and he tried, but he did not have too much accurate data, statistics, facts and figures, but he tried to, and also he calculated the per capita income. So he calculated per capita income, and he said that ki per capita income of Indian is rupees 20. So he said that ki the per capita income, that is 20, and per capita income, national income divided by total population, so that became 20. So he said that ki the per capita income of Indian is rupees 20, and that was a very big amount at that point of time. Although he does not have the accurate facts and figures. Although he does not have the accurate fact and figure guys. Is that clear? Now, in 1931-32, Dr. V.K.R.V. Rao, he tried to calculate the national income on scientific basis. So, Dr. V.K.R.V. Rao, he tried to calculate the national income of India on scientific basis, but it was not very much successful. So, it was not very much, not very much successful, as they do not have the exact data, facts and figures. So that was not very much successful. Now guys, after independence, what happened? There was formation of National Income Committee, and that was in 1948-49. So National Income Committee was formed under P.C. Mahalanobis. That is Prashant Chand Mahalanobis. He was a very famous statistician of India, and his birthday is celebrated as National Statistics Day. P.C. Mahalanobis, one of the founder member of Indian Statistical Institute, ISI. This is called Indian Statistical Institute. And when National Income Committee was being constituted under the leadership of P.C. Mahalanobis, very famous personality, and the second 5-year plan was Nehru Mahalanobis plan. So he was also associated with the second 5-year plan, which is called Nehru Mahalanobis, that we have discussed. And Nehru means Pandit Jawaharlal Nehru, and Mahalanobis means P.C. Mahalanobis. So Nehru Mahalanobis plan. And when this national income was calculated, he said that the national income of India, he calculated was rupees 8710 crore. So 8710 crore, and per capita income of was rupees 225. So was rupees 220. So now the per capita income was rupees 225. Now from 1955, so 1955 till now, Central Statistical Office started calculating the national income. So national income, now it was calculated by Central Statistical Office, that is CSO, and this works under MOSPI. So this works under Ministry of Statistics and Program Implementation. So this works under Ministry of Statistics and Program Implementation. So now guys, the work of calculating the national income, it is did by which organization? So it is did by Central Statistical Office or Central Statistical Office. Is that clear to all of you? Is that clear to all of you guys? Then do let me know. Okay, so this was about the pre-independence and post-independence calculation of the national income. Now my dear learners, let's discuss the method of calculation of national income. So there are three methods, and this question directly being asked in the CUET UG General Aptitude Test last year. That was how which of the following is not a method to calculate national income? That was the question, and we have three methods of calculating the national income: production method, income method and expenditure method. So the fourth option out of these three, fourth option will be the correct answer of that question, which of the following was not a method to calculate the national income. So there are three methods of calculation. This is production method, income method and expenditure method. And in today's session, I am going to discuss all these three, because from all these three, the question may come in your examination. So first of all guys, let's start our discussion with the production method. So let's start the discussion with the production method. Now let's start with the production method, and in production method guys, First of all, you have to understand what exactly is the GDP. This is gross domestic product. Gross domestic product, what exactly it is? So it is the monetary value of all the final goods and services produced by the people living in territorial boundary of the country in a financial year. So it is defined as the monetary value of all the final goods and services produced by the residents of the country within the political boundary in one financial year. So first of all guys, there are some keywords in this definition. First is monetary value. Monetary value, what it is? So it is value in terms of money, because every product has some monetary value. Then final goods and services. That cannot be that cannot be further value added. Then provides services provided by the residents. Residents means the people who are living in India. So people living in India. If I am talking about India, so let's take the perspective from India. So if I am talking about the Indian perspective, so that it will be easy for you to understand the condition, it will be easy for you to understand the concept. So resident means the citizens plus foreigners. Foreigners. So resident means the citizens plus foreigners, because in every country you will find the citizens, they are living, and plus the foreigners, that means the people from different countries, they are also living and earning in the country in a political boundary. Political boundary means land boundary plus water boundary if available. If available, because if the country is landlocked, then there will be no water boundary, so then there will be no boundary. So water boundary if the country is landlocked. Therefore if I have written if available, because if the country is landlocked, that means surrounded from the land from four of the side, so there will be no water boundary. In a financial year, so financial year for India, it is 1st April to 31st March. So guys, it is defined as the monetary value of all the final goods and services which is produced by the citizens of by the residents of the country in a financial year. Now let's take a example to understand this whole scenario. So this is the rough map of India. So this is not a rough map, this is just a rough map of India, so that I should explain you what exactly is the definition. So India guys, you know India is a peninsular country which is surrounded from water from three sides. So here we have Arabian Sea, there we have Bay of Bengal, and on below we have Indian Ocean. So guys, in India, first of all Indians are living. So first of all citizens plus Indians are living plus foreigners foreigners are living. So Indians means the people plus companies. Foreigners means people plus foreign companies are there. And here we have the Bay of Bengal, here we have Arabian Sea, and here we have Indian Ocean. So first of all guys, if you will see this is just an outline map to make the things understood. So monetary value of the final goods and services which is earned by Indians, which is earned by the people of India, plus companies who are working in India. That means the branches of the companies, the company which is working in India. Other than this, the final goods and services which is earned by the foreigners who are living within the territorial boundary of India, and the foreign companies whose branches they are working in India. So if I say 1, 2, 3, 4 plus the final goods and services which is earned from the water boundary. Now guys, according to United Nations Convention Law of the Sea, the water boundary of any country, it is 200 nautical miles from the seashore. 200 nautical mile from the seashore, and 1 nautical mile is equal to 1.852 kilometers. 1 nautical mile is equal to 1.852 kilometers. So whatever the marine activity or maritime activity that is happening in Arabian Sea, Bay of Bengal and Indian Ocean within 200 nautical mile, within 200 nautical mile, this is called EEZ, exclusive economic zone. This is called exclusive economic zone. This is also known as exclusive economic zone. That will be all, that will be under the, that will be under the, that is under the political boundary of India. So let's mark it as a 4, 5, 6, 7. So now if you have to calculate the GDP of India, if you have to calculate the GDP of India, you have to add the monetary value of all the final goods and services from 1st April to 31st March, from 1, 2, 3, 4, 5, 6, 7. So if you have to calculate GDP of India, you have to add the monetary value, add the monetary value of final goods and services, final goods and services from 1, 2, 3, 4, 5, 6, 7. So then you will get the GDP of India, then you will get the GDP of India. So guys, generally in the GDP, whatever the economic activity which is happening within the political boundary of India is taken into account. So whether it is the income which is earned by the Indians or the income which is earned by foreigners who are working within the territorial boundary of India, that is being taken care of. So in GDP guys, you will find that the Indian companies and Indian people, the final goods and services, monetary value of all the final goods and services which is earned by Indians within the political boundary of India, plus foreigners, whether it is a foreign company, whether they are the foreign people who are earning within the political boundary of India. And since India is a peninsular country, so up to 200 nautical mile from the seashore, whatever the economic activity it is happening, like fishing, like you have to extract the oils and natural gas, so the monetary value of that final goods and services, that is also being added. So in GDP, whatever the economic activity it is happening within the political boundary of India, that is taken care into account. So whenever guys you will find GDP, then all the, then monetary value of all the final goods and services produced by residents within political boundary of India, within political boundary, is taken care of, is taken into account. So whenever you will find GDP, guys, please remember whatever the economic activity which is happening within the political boundary of the country, any country, just I am giving you an example through India so that it will be easy for you to understand and you can correlate the concepts easily. So that is taken care into account. So that is being taken care of. So here, if Indian company is working outside India, that is not being considered. So if Indian who are working outside India, outside the political boundary, or the Indian companies who are which are working outside India, that is their income is not calculated. So Indians, whether they are citizens and companies which are working outside India, which are working outside India, is not taken in account, is not taken in calculation of GDP of India. So if any person who is working outside India, and if any company is working outside India, if the company is Indian but they have the branches outside India and there they are working, so their income plus the citizens of India who are working abroad, their income is not considered in calculating the GDP of India, because that all economic activity, it is happening outside the political boundary. Why it is not being taken care of? Reason is this, ki all the economic activities which is happening, that is outside the political boundary of the country. Therefore the people who, the Indian companies or whether the Indian people who are working outside the political boundary, that means if they are working abroad, their income from after selling the final goods and services, that is not being taken into account. I hope it is clear ki GDP means within the political boundary, not outside the political boundary. So within the political boundary, whatever the economic activity is did by the residents, that means the people plus the companies, and residents means foreigners who are working in that particular country, the people, the companies, their income is taken into account, not the people of the country who are working, or the company of that country which are working abroad, they are being taken care of. I hope it is clear to all of you that GDP means through within the political boundary of the country. I hope it is clear to all of you within political boundary of the country. Is that clear? Is that clear, guys? Is that clear? So there I have given you an example so that you can understand properly. If Indian citizens own a restaurant in Dubai, the income that he earns from that restaurant will not be added to the GDP of India, because restaurant is outside the domestic territory, or simply you can say political boundary of India. So in GDP of Dubai, the income will be calculated, income that is owned by an Indian person who is operating restaurant in Dubai, that will be calculated in GDP of Dubai. Same, so this will not be calculated in the GDP of India, that will be calculated in GDP of Dubai. So this income will be, so the income will be calculated in GDP of Dubai. because it is happening within the political boundary of Dubai, because it is happening within political boundary of Dubai. So this is happening within the political boundary of Dubai. Now guys, if a foreigner set up a company in India, then the revenue generated from that company will be included in our GDP, because that company is inside the domestic territory of India. So if a foreigner that set up the company or their branch, they set up a branch of their company in India. So whatever the income is earned by that branch of that company is calculated in the GDP of India. Reason is this, that branch is operating within the political boundary of the country. So I hope guys it is clear that GDP means within the territorial boundary. So all the economic activities, all the and the monetary value of all the economic activities which is happening within the political boundary of that country, that is being taken care into account when you calculate the GDP. GDP simply means ki within the political boundary. I hope it is clear to all of you. I hope it is clear to all of you, dear. I hope it is clear. Now, after calculating GDP, what we have to calculate? So GDP is calculated on two bases. One is nominal GDP and second is real GDP. So next, first we have nominal, next we have real. Nominal GDP means GDP at the current price. So when you calculate GDP at the current price means the price which is prevailing in the market. This is called nominal GDP and it is calculated without adjusting inflation. So it is calculated without adjusting inflation. So nominal GDP, what it is? So nominal GDP is the GDP at the current price that is calculated without adjusting the inflation. And real GDP is nominal GDP adjusted by inflation. Adjusted by inflation. And what exactly is the inflation? Inflation is the rise in the price of goods and services over a period of time. So what is inflation, guys? Inflation word came from the word inflate. And inflate means to expand. And inflate means to expand. So what is inflation? Inflation is the rise in the price. Rise in the price of goods and services over a period of time. So rise in the price of goods and services over a period of time. So what happens, my dear learner? Generally inflation, the price rises. So what happens, guys, ki do not take inflation. For example, if you go to vegetable market and you find ki potatoes, they are selling 20 rupees a kg. Now on another day you went and you saw, and when you ask about the price of the potato, so they said, the shopkeeper said it is 22 rupees a kg. So you will not say that ki, okay, the inflation in the price of potato came, so there is inflation in the price of potato, because earlier a day before yesterday it was selling for 20 rupees. Now the same potato is being sold for 22 rupees, so it will not be considered as inflation. Reason is this, it is for a small time period. So over a period of time, it does not mean ki one day, 2 day. That has some, for example, a month, 2 month, 3 month, or more than a year. So then it is called as inflation. It does not mean ki now one day it was selling for 20, now another day you went, it was again on rupees 20. So you will say ki now the inflation in the price of potato came. So it is rise in the price of goods and services over a period of time. Nominal GDP is GDP at current prices, that is adjusted without inflation, and real GDP is nominal GDP adjusted by inflation. Adjusted by inflation means that the inflation is taken care into account. Is that clear? I hope guys, is that clear to all of you? So nominal GDP is the GDP at current price that is calculated without adjusting inflation, that is used for the international markets. When you compare the GDP in the international market, then it is used, and real GDP is used for calculation to the day-to-day basis. Now guys, there is a concept is called GDP deflator. GDP deflator. And what is GDP deflator? Generally you will be asked the formula. So that is nominal GDP divided by real GDP. So nominal GDP divided by real GDP into 100. So this is called GDP deflator. So nominal GDP divided by real GDP into 100 is called GDP deflator. I hope it is clear to all of you guys. GDP deflator, you can be asked directly the formula how GDP is deflator is calculated. So nominal GDP divided by real GDP into 100. Now guys, once you calculate the GDP, now you have to calculate GNP. So what exactly is the GNP? GNP stands for gross national product. Gross national product, it is the total monetary value of all the final goods and services produced by the citizens in a financial year. Now, how it is calculated? First of all, let's understand the example. Let's take an example. For example, my dear learners, this is India, and here is a foreign nation, that is USA. Let's take an example. Let's take an example. Here is India. This is rough map. This is not a real map at all. This is just for you to understand the what is GNP, and this is a country. For example, take it as a US, and this is India. This is just a rough map. Now in India, guys, Indians are there. Indians are there. Indians means citizens plus companies. Now in India, take an example of the people who are American. So American people are there, plus American companies are there. And in USA, you have the people of US people. This is people plus companies, plus you have Indians, plus you have Indians, people and companies. The branch of the companies of Indian, that is in US. Now guys, see what happens ki whatever the people of US they will earn in India. So whatever the earning of the people of US, whether it is the people or company, they will send some parts to their country. For example, my dear learners, if a person is living in USA and he is working in US and is sending money to their parents, for example, that is in India. So what happens guys, ki what example is, if a person, if an Indian is living in USA and is sending money to the parents who are living in India, same condition is with the companies. Now if a company is working in USA, after paying the necessary taxes and duties, the rest of the amount they will send to the head office. So from Indians, it will come to India. So from it will be USA to India. Now what the same thing happens with the Indians as well. Whatever the US people they are earning in India, after paying the necessary taxes and duties, rest of the part or the profit they will send to their own country. So same is with the US people to India. So then it will be USA to India or India to USA. So This is called export. So you will find that the people of the Indians, after paying the necessary taxes and duties, whatever the profit will be there, it will be transported to Indians, and whatever the US people and companies they are earning in India, after paying the necessary tax and duties in India, they will send the money to their head office or to the people, that is America. So guys, it is considered as the, so both of these. Now guys, what happens if you want to calculate? So here guys, what comes? It comes the income that is earned by the citizens. Income here, what it comes, that is earned by the citizens of the India. So this is X and this is M. This is X and this is M. So what happens, my dear learners, this X minus M, it is called NFIA. This is net factor income. Income from abroad. So this is called inflow and outflow of money. Better it to write inflow and outflow of money. Inflow and outflow of the money, better to write, so that you should not get confused. This is inflow and outflow of money. So this is called inflow and this is called outflow. And NFIA, this is called net factor income from abroad. This is inflow minus outflow of. Now guys, if you will see, the investment of the US people, the investment of the US companies in India is more as compared to the Indian investment in USA. So guys, overall you will find that especially for the developing nation, so especially for developing nations, this outflow is greater than inflow, therefore NFIA becomes negative. So NFIA becomes negative. Reason is this guys, ki the investment of the developed nation in developing nation is more as compared to the investment of developing nation in a developed country. So in India guys, the investment of US companies will be more as compared to the investment of Indian companies in USA. So what will happen guys, ki the outflow will be greater than inflow. Therefore the value of NFIA will become negative. Although guys, the standard formula to calculate NFI, to calculate GNP is GDP plus NFIA. That becomes GNP. Therefore, in developed nation GDP, in developed nation GDP, GNP is always greater than GDP, because NFIA is positive, because NFIA in developing nation is positive. Where guys in developing nation what happens is, since NFIA, since the formula becomes GNP is equal to GDP plus minus NFIA, NFIA. Reason is this guys ki the inflow of the money is more than the outflow. The outflow of the money, sorry, the outflow of the money is more than the inflow. Therefore, GNP becomes GDP minus NFIA. NFIA. Therefore, in developing nation, guys, GDP is greater than. So, in developing nation, what happens? Ki the GDP is greater than GNP. Reason is this ki the NFIA value becomes negative. NFIA value becomes negative. Therefore, for India, guys, what exactly becomes the formula? That is GDP minus NFIA. Reason is this ki the outflow of money from India is more than the inflow of money in India. So NFIA becomes negative, and once NFIA becomes negative, the overall GNP decreases. Therefore, GDP is always greater than in developing nation and underdeveloped nation. Is that clear? So now you calculated GNP, that is GDP minus NFIA. Now you calculate, now we got GNP. Now guys, now from GNP what we have to calculate? From GNP we have to calculate NNP. So from GNP we will calculate NNP. NNP is net national product. Now how to calculate net from gross? You have to subtract something to get net from gross, and what we subtract? We separate depreciation. So NNP is GNP minus depreciation. Depreciation, what it is? So it is normal wear and tear. Normal wear and tear due to which the price of the product, price of the goods decreases. So it is normal wear and tear due to which the price of the goods decreases. So we get NNP when we subtract depreciation from GNP. So now NNP, it is calculated on factor cost and market price. Factor cost is cost of production, and NN and market price is the price at which the product is ready to be sold in market. Price at which the product is ready to be sold in market, that is called market price. Now it is called NNP at FC and it is called MP. So NNP at FC and MP. Now how NNP at FC is calculated? So NNP at FC, that is factor cost, that is the price which the cost of production. Now guys, MP it is the price on which the product is ready to be sold in market. Now how you calculate NNP at MP? First of all, you will calculate NNP at FC, that is factor cost, cost of production. Then you will add indirect taxes like GST, and if the products become costly, then government provides subsidy. So then government provides subsidy, that is a rebate, and the rebate is reduced. Now this is how NNP at MP, that is market price, is calculated. Now what you have to do? NNP at MP, take on the left hand side. So NNP at MP minus indirect taxes plus subsidy. Subsidy if given. If given, then you have to add. If not, then you have to subtract. If given. If subsidy is given, then it is alright, and if it is not, then let's suppose it as a 0. Then it becomes NNP at FC. And NNP at FC, it is known as national income. So NNP at FC is called national income, and real national income is nominal national income adjusted for inflation. So whenever we talk about the real things, this is adjusted with inflation, that is the rise in the price of goods and services. So real national income is nominal national income adjusted for inflation. So this is national income, this is nominal national income without adjusting inflation, that is on the market price, and when the national income is adjusted for inflation, this is called real national income. I hope it is clear. So real is always adjusted with inflation and nominal is at the market price. Is that clear to all of you? Is that clear? Now let's come to the next is the income method. So this is how we calculated the national income through production method. Now let's calculate the national income through income method. Now guys, how you will get income? How will you get income? When you will produce goods and services. So how you will get income? So income when you is got when you do some production. So income, how you get income? So whenever you do any type of productional activity, so income what it needs? Production, and production can be of the goods or services. So production can be of the goods and services. Production can be of goods and services. Now guys, let's discuss about the factors of production, the factors that help in the productional activity. There are four factors of production. There are four factors of production. Which are the four factors of production? They are land, labor, capital and entrepreneurship. So first of all guys, from land, what you get? You get rent. To labor, you give wages, salary, and if they are high paid, so remuneration. Then capital gives interest, and entrepreneur earns profit. So entrepreneur earns profit. So whenever guys, for example, if you wish to set up a factory, just if you wish to set up a factory for production of any goods, so if you, what you will do, first of all, whether you will take the land on the rent or whether you will purchase the land. So first of all guys, you will take the land on the rent. For example, initially what you did, you took the land or the factory premise on the rent. So first of all you will give the rent. Then labor, so you have deployed labor. So labor to whom, what you will give? You will give wages, salary or interest. Then if you have borrowed money from the bank to start the business, then it is capital. To then you have to go give interest. And entrepreneur means businessman. Why businessman works? So businessman works to earn the profit. So entrepreneurship earns the profit. Now guys, first of all, when you add rent, wages, salary, interest and profit, then you will get national income. So when you have to add rent to calculate national income, you have to add rent plus wages, remuneration and salary plus interest plus profit to get the national income. I hope it is clear. Just add these four components. Now guys, there are some income which is not being calculated. There are some income. So from this particular activity, you will get income. So once you will do all these things, you will get income. So you will earn income. So you will have income. So you will earn income. Now guys, there are some activities, although they are economic, but they are not being taken into account for calculation. So there are some economic activities are also there which is not being taken care of account while calculating the national income. Now which are those activities? First activity is transfer payment. So first activity is transfer payment. Now what is transfer payment? For example, my dear learners, if you are studying outside your hometown, so what your parents does? Your parents sends money to you every month. So that is called transfer payment. This will be added in the earning of your parents, and also this will be added in the earning of yours. So this is called the transfer payment. So it is said that when payment, when the same payment is sent to two person, when same payment, when same source of payment, when same source of payment is added twice, this is called transfer payment. So when your parent sends money to you for your monthly expenses, what happens? The earning, the amount of the money which is sent by your parents, that is added in your income, and it is already being added in the income of your parent. So that will be double counting. So to avoid double counting, so in order to avoid double counting, that is not being added. Next is household work done by family members. So whatever the household work is did by family members. Now guys, if any type of household work, for example, your mother cooks for you or your sister cooks for you. So although they have the monetary value of their work as well, so because they are giving rendering services, but that is not being added because it is not did for any type of economic activity. It is not being did to earn money. For example, if your sister cooks for you or washes your clothes, so do you give your mother or your sister money for doing that? Or if sometimes you broom your house, so does your parents give you money? Okay, you are doing the household activity, take this money. So it is not happens, it does not happen. So it is did due to love and affection. So due to love and affection. But if you hire some maid or a domestic help, then it will be added. But if you hire maid, if you hire any domestic help, then the income will be added, because they are not doing for the love and affection, they are doing for their earnings. So if you hire any domestic help, then whatever the money you are giving to them, that will be added in the national income, because they are rendering you services. They are not doing just for love and affection. Next is income earned from illegal sources. So income earned from illegal sources, although it is income, but it is not calculated because of ethical and legal issues. So income earned from illegal sources like ransom, example, ransom, then funding the terrorist organization, funding terrorist, or ransom, or you can simply say that black marketing, ransom, or bribe. From their income is also being earned, but they are not supported by law. Since they are not supported by law, therefore it is illegal and it is not being added. Then income earned from selling and purchasing second hand goods. Income earned from selling and purchasing second hand goods. For example guys, if you have a mobile phone, first of all you purchased the mobile from that company, and then again you sold that mobile phone, same mobile phone, to some another one. So first of all guys, income from purchasing and selling second hand goods is not added because the good is same. There is no value addition. There is no value addition on that mobile, and simply what you do, so you took that mobile and again sold. So the same item is sold twice, or the same product is sold twice. So why it is not being added? Sometimes you might be thinking, first of all, when I purchased the phone from the company, I paid to the company, and now I am selling the same phone to the customer, I am getting the money. So it should be added. But what about that product? So product is same, that same mobile phone, without having any type of value addition that you did. So you do not added any software or any extra component. So do not think that okay, I have added the screen guard, I have just given the mobile, I have just added mobile cover. So it's not value addition. It is the supporting accessories. Do not think that okay, I have just put tempered glass, non-breakable tempered glass, so I have value added the things. No, value addition, that means if you have not added any software, any other special feature which was not earlier present in that phone, so then it should be value addition. If you add something new to that thing, or if you have modified the phone, then it is the value addition, then it will be calculated in your income. But if you have not did any type of value addition, simply you purchase the phone and sold to the another one, so the product is same, therefore it's not being added. So the product is sold without value addition, the product is same, so the product is same, therefore not purchased. Next we have old age pensions. Old age pension which is given to the elderly people, it is not added. Why it is not added? Because it does not create any production. It does not generate any income. Although it is an income for the old age people, but it does not have any type of productional factor. So this income, is it came from any productional activity? Does the old age pension come from any productional activity? So it is not being added. Reason is this ki there is no productional activity involved. No productional activities involved. But salary is added, my dear learners. Salary is added because salary, why you get salary? For rendering the goods and services. For rendering the goods and services, you get the salary. So salary will be added, but not old age pension, because once you get old age pension, you do not offer any productional activity. So you do not offer any productional activity, therefore it is not added. Next is unemployment allowances, which is given in some country. Same condition, no productional activity. No productional activity is involved, therefore scholarships. Another example is the scholarships. Scholarship, also no productional activity in terms of commerce is involved. So do scholarship generate income? So that is for the person who are holding the scholarship, but whether they have did any type of productional work to earn that scholarship, do not say that they have worked hard to earn that scholarship. It is not being taken care of in the economics because that does not generate income. So that is not a productional activity. So since scholarship, because it does not generate, no productional activity, no productional activity is involved. So no productional activity is involved, therefore these incomes, they are not being calculated, they are not being taken care of while calculating the national income. So while calculating the national income, these things, they are not being included. Is that clear to all of you? Is that clear to all of you? So I hope, my dear learners, is that clear to all of you? The things which is not being calculated for calculating the national income of the country. Reason is this, they do not, either they do not generate any productional activity, or sometimes it is the reason of double counting, and another major thing for calculation, that is the unorganized sector. So in India we have multiple unorganized sector, and the income that varies from sector to sector. There is a huge income disparity from the sector to sector. Therefore guys, it is not being taken care of. So this is the another method of calculating. Next we have the expenditure method. Expenditure method to calculate the national income. This is total consumption expenditure. Then we have investment expenditure, then government expenditure, then exports minus import. So how it is calculated? First of all, the formula is expenditure method. It is national income C plus I plus G plus X minus M. So X stands for export, or N imports for CI plus G, X minus M. So C is consumption expenditure that is did by the residents of the nation. So C is consumption expenditure. That is did by residents of the nation. I, this is investment. This is investment expenditure. So I, that what it stands for? So I stands for investment expenditure. So I stands for investment expenditure by business and household. So investment did by business and household. So business also invest, and the people of India, they also invest. So people also invest, business also. Without investment, business cannot run. Then we have G, that is government spending. Government spending. And then we have X, this is for the export, and M for import. So that is net export. So this is net export. So C plus I plus G, X minus M. So this is national income through the expenditure method. So this is how, my dear learners, national income, it is calculated through the expenditure method. Is that clear to all of you? So is that clear to all of you guys? So through this you can directly calculate the national income through expenditure method. You can directly calculate the national income through expenditure method. So my dear learners, here we discussed about the national income calculation and the most important sector in the contribution of in our GDP, that is the service sector. Primary sector contributes least, then we have industrial sector or secondary sector, and the tertiary, which is the service sector, contributes the most. So my dear, with this I conclude the session of today, and I hope you have understood the whole scenario of calculating the national income of the country. So that was all for the day. Let's meet in the next session.